Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on everything you need to know at 3 p.m. Eastern Time. President Biden's State of the Union saw off the script comments, finger wagging, jeers, and a couple of outbursts.
Let me give you, anybody who doubts it, contact my office. I'll give you a copy. I'll give you a copy of the proposal.
But what in his speech matters for the economy and the markets? We are going to break down the economic news that you might have missed.
Like a football game,
didn't it? It did. Very lively.
Plus, the earnings parade continues. We've got results from Uber, Under Armour, and the fast food space as well. We'll bring you the winners and losers of a very busy day. And of course, Bob Iger returns to center stage tonight for Disney's latest results. Investors will be listening closely for the tone of the earnings call as Iger contends with activist investors and streaming woes. We'll tell you what we're looking for in the highly anticipated report.
Also, this is Iger's big return. They've called in the GOAT. Lots of anticipation.
All right, well, we'll have much more on Disney in just a little bit, but first I want to take a look at the markets here because you are looking at red on your screen in the final hour of trading. The Dow off 160 points, Nasdaq off just about 1.5%. You're looking at the S&P down nearly 1% today. Some of the losses being attributed to some of the commentary that we've gotten from Fed officials this week saying that the hiking doesn't seem to be over right now. More might be necessary in the future, and that's why we're seeing the Nasdaq, the leader here to the downside, the underperformer so far in today's market. While as equities dip, we're also seeing bonds pull back just a bit when you take a look at yields, at least. Yields off just about 2 basis points when it comes to the 10-year at 3.66. Taking a look inside this action here, breaking it down by sector, all 11 of the S&P sectors are moving to the downside today. Communication services by far the worst performer. That sector off nearly 3%. Utilities, technology, not too far behind here. But again, losses across the board. Looking inside the Dow, we mentioned those earnings that we will be getting from Disney after the bell. Taking a look at that stock ahead of these results, off just about 0.5% today in the trading day ahead of the results that we will get here this afternoon. Over the last 3 months, though, the stock has gotten a bit of a bounce, at least over the last month or so, up about 11% in the last 3 months, Dave.
All right, thank you, Shauna. Let's get you up to speed now on what will be the market story of the day. The House of Mouse reporting earnings after the bell. Bob Iger's first call since returning as CEO in late November. Among the many issues, investors are eager to hear him address the future for Hulu and ESPN. Activist investor Nelson Peltz, Avatar, and of course, streaming losses. Shauna, most of the questions we have can't be answered until that highly anticipated call, including what's the plan for licensing content to streaming competitors. As far as the report goes, I have a sneaking suspicion we could hear about layoffs. In a February 2nd shareholder letter, Disney referenced its, quote, cost reduction plan without offering specific details. Evercore ISI analyst Vijay Jayant wrote in a note, quote, cost cuts at a similar scale to the ones NBC Universal is targeting in 23 could translate to $1.3 billion in savings over the next several years. A BOA note also referenced structural changes. For context, Disney currently has 220,000 employees. That is 30,000 more than last year. Their last major cuts came in 2020. They're around that 30,000 mark. It just feels like one of those times there's been nothing on this, but he needs to have something big to assure investors. Is it layoffs? We hope not. Feels like it could be the time.
It certainly feels like it could be the time, especially given what we have seen so many other companies do during this earnings season, announce layoffs, being forced to cut costs across their business. What I will be focusing on here is Disney Plus subscriber growth, also just overall their DTC business, direct-to-consumer business. We know that was a focal point of the last report when the company reported $1.5 billion in losses for this division. $4 billion for the year. The street remains pretty optimistic that those losses should become a bit narrow, improve here over the coming quarters. Citi was one of those analysts out saying that he expects some improvement here from Disney going forward. In terms of total subscribers, we're looking at an estimate of just around 164 million. Putting that in perspective, that would be essentially flat from what we heard last quarter from the company. But I think the losses there, really any momentum that they are seeing or lack thereof in their DTC business, that's going to be a huge point here for investors.
Yeah, the subs are going to be a different story because of this major loss of the Premier Cricket League in India, which cuts the number but necessarily the revenue because those are lower cost subscribers. As we move on to the call, and you're hosting after the call with Brad and Ali Canal, what's your biggest question there? I really hope we get some clue about Hulu, but I actually don't think we're going to get it, unfortunately. I think investors all want to hear it. I don't think they will.
Hulu, yeah, also just ESPN. I would be very, very surprised if Iger does comment on that. Clearly, there's been lots of speculation whether or not Disney should spin off ESPN. This is something that's been talked about now for years. Yep. Kind of moved away from that conversation most recently here. But you would think that it might come up on the call. If it does, I'm not too optimistic that Iger is going to answer it, though.
I agree there. Right? He's a sports fan. He's very close to Jimmy Pitaro. I don't think he wants to spin off ESPN. We move on now. As the economy was the focus of President Biden's State of the Union address, Biden touting strong jobs numbers while laying out his vision for a billionaire tax and quadrupling the tax on share buybacks. Let's hear what he had to say.
Corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments. They'll still make considerable profit. Let's finish the job and close the loophole to allow very wealthy to avoid paying their taxes. Instead of cutting the number of audits for wealthy taxpayers, I just signed a law to reduce the deficit by $114 billion by cracking down on wealthy tax cheats. Passed my proposal for the billionaire minimum tax. You know, there's 1,000 billionaires in America. It's up from about 600 in the beginning of the term. But no billionaire should be paying a lower tax rate than a school teacher or firefighter.
Hard to argue with the logic there. Stifel Chief Washington Policy Strategist Brian Gardner with us now to discuss. Brian, do you think the president's tax proposals have any shot in this Congress?
Almost none. Dave, let's start with the buyback tax, because I think that actually has the better shot of passing. Maybe not in this Congress, but in future Congresses. What we were telling clients when it was included in the IRA, the Inflation Reduction Act last year, is once you get that into law, then each party can look at it and dial the number that they want to raise revenues. And there are a number of Republicans who have been critical of buybacks. So I don't think the Republican Party is monolithic in its view on stock buybacks and taxing stock buybacks. So I think down the road, yeah, it's possible, just not now. The billionaire tax, I think there's absolutely no way. I think it was done in there for put in the speech for political messaging. I don't think it's a serious proposal. Republicans will not touch it. I think a lot of Democrats on the Hill won't touch it. There is certainly a group of Democrats who support it. They're very loud about their support, but they're also fairly small in number. And so I just don't think there's widespread support for a billionaire unrealized capital gains tax.
Brian, he struck this optimistic tone. He was trying to entice the GOP to work with the Democrats, highlighting some areas that he thinks they can work together. We know, though, that this Congress is so divided. Are you optimistic that the two sides will be able to come together on anything, and what would that be?
No, so I'm not overly optimistic, sorry to say. Now, I think part of that messaging last night was that the president is, kind of inching towards a reelection announcement. And he's trying to position himself as being reasonable above the fray, while Republicans, have been fighting amongst themselves. They had a contentious vote for speaker. So there's a lot of politics, you'll be shocked to hear, going on with that part of the message. In terms of what can get done this year, I think it's really a handful of must-do things. The debt ceiling, I think that will get done, but it's going to be a really, really tough fight. I expect there's going to be a government shutdown in October. The government will eventually reopen, but that's going to be tough to do. Then there are a handful of issues. He mentioned the insulin price cap. That's a possibility. I wouldn't give it overwhelming odds, but it's possible. Antitrust. Both parties were working on that in the last Congress, a bill to regulate some social media and tech platforms that didn't get across the finish line, but it's not dead. It could come back. So I'm not totally pessimistic on some of those things, but they all face long odds because, look, it's just a very divided country. We're inching towards a re-election, and it's not in either party's interest to be helping the other side right now. And my final point before we move on is just that we are in an era where politics is a zero-sum game. One side does not want to see the other side succeed, win at all. If they're winning even in a small way, then I'm losing, and that's not an environment, that's not an attitude that's conducive to producing political compromise.
And nothing is more emblematic of that than the State of the Union when you got the rise and the fall of the ovations and whatnot. He does have some strong talking points, does the president, on the economy, but this is perception versus reality. And when it comes to the reality of these polls, Gallup shows 50% of the American public say they are worse off, despite, again, really robust job growth. GDP topped expectations. Can anything he said or the way he delivered it last night move the needle?
No, I think there is this anxiety among voters. It was showing up in polling prior to the midterm elections. And I kind of got things wrong a little bit in the midterms. I thought Republicans were going to do better because of these polling numbers. These polling numbers are not new. They've been out there for months. And yet Democrats did better than that polling data would suggest, partly because Republicans aren't addressing in voters' minds issues important to them. They ran on grievance, not governance. If Republicans can kind of shift that message and get back to a governing message, then I do think this issue that the Biden administration has and the Biden campaign will have on people feeling anxious about the economy, that's going to come back and hurt them. And there's not a lot the president can say to convince people otherwise. People view their own circumstances as they view them, and they don't want anybody from Washington telling them otherwise.
Brian, speaking of that polling, the Washington Post ABC poll, 58% within his own party, within the Democratic Party, want a different candidate for 2024. What do you see as the future of the Democratic Party, and whether or not Biden, do you think, will be able to kind of gain some more of that support over the next 2 years?
So for his prospects in 24, if he wants to run, there's nothing to stop him. And really, there's no viable Democrat that will step up and challenge him in a primary. No viable Democrat will have a chance to knock off a sitting incumbent president. The party will rally around him, and there is history in the background. It's been a while since we've had some challenges to incumbents, but there are people in the party that are wise enough to know that's a recipe for disaster. So he's not going to face a serious challenge, and he will be renominated if he wants to run. Longer term, there are challenges for the party, which way they want to go. It used to be a very working class party, a party of labor halls. It's become a party of faculty lounges and kind of coastal elites, making inroads with suburban voters too, to be fair. But it's a party, where we spend a lot of time talking about Republicans and their divide and where they're heading. Democrats have some thinking to do too about what kind of party and how they want to be, how they respond and reach out to working class voters, and kind of, especially in this populist era that both parties are going to trying to tap into. And we saw a lot of that last night.
All right, Brian Gardner, always great to get your reaction here. Steve Full, Chief Washington Policy Strategist. Thanks so much. We are just getting started here on Yahoo Finance Live. Coming up, a green light for Uber, the ride-sharing company, reporting that it says what it says is its strongest quarter ever. We will break down why some analysts say that it has a big advantage over its rival Lyft. Then National Urban League CEO President joining the program to share his key takeaways from President Biden's State of the Union address. An earnings season rolls on. Robinhood and Disney reporting after the bell. We will break down each company's latest report. Stay with us.
Yo, check it out. after the Disney earnings call ends, that's when we go live. Brad Smith here with Shauna Smith, no relation, but of course, Yahoo Finance family. We're going to be breaking down what the tone, what the vibe of the call is. Of course, anything on streaming, all things Hulu, all things Disney Plus, and all things ESPN Plus.
I'm going to be looking for any cost-cutting measures, talks about layoffs, what exactly that looks like. And also, this is Iger's big return. They've called in the GOAT. Lots of anticipation.
Quick, favorite Disney movie?
Oh gosh, that's a toss-up. I'm going to go with Moana or The Lion King.
Done deal. Oh, I'm going Aladdin. Yo,
There
you can
you
check us
go.
out after the Disney call ends. Yahoo Finance begins.
We'll see you then.
A chorus of Fed members speaking today on the outlook for the economy and inflation. Here's our very own Jen Schonberger with the roundup. Hi there, Jen.
Hi, Dave. That's right. 3 members of the Federal Reserve pointing to strength in the job market, supporting inflation in the services economy now, requiring the Fed to continue raising rates and remain steadfast in keeping interest rates high. Fed Governor Chris Waller, Minneapolis Fed President Neil Kashkari, and New York Fed President John Williams all noting that wage growth is still well above levels consistent with the Fed's 2% inflation target, pointing to continued inflation in the services sector, excluding housing. Kashkari noted that wage growth closer to 3% would be more consistent with 2% inflation. And Fed Governor Waller says while some think inflation will drop quickly this year, he's not seeing signs of that, and he's bracing for a, quote, longer fight to get inflation down to our 2% target. The key, says New York Fed's Williams, is to raise rates to levels that will restrict growth and keep them there for a few years to continue restraining growth. Speaking at a Wall Street Journal event, Williams said raising the Fed funds rate this year to between 5 and 5.25%, which is what was penciled in December, is, quote, very reasonable for a rate hike path this year. Now, Williams noted that future rate hikes of a 0.25 percentage point in size, quote, seem like the right size, but ultimately it will depend on the data. Williams also said that if financial conditions loosen, that would cause the Fed to raise rates higher. Guys?
All right, Jen Schonberger, great stuff. Thanks so much. Well, stocks are falling this afternoon in the final hour, trading all three of the major averages trading to the downside as investors shift their focus from that Fed policy that Jen was just talking about to earnings. So far this earnings season, reports have been mixed with over 70% of the S&P posting results. So what does this mean for equities going forward? We want to bring in Ryan Payne, Payne Capital Management President and host of the Pain Points of Wealth podcast. Ryan, it's great to have you back here in studio. So here we are, magical. 70% of the S&P companies have reported earnings so far. Your big takeaway, because from a 10,000-foot view, earnings have been pretty mixed so far.
Yeah, I mean, as long as they're beating, right, and that's beating expectations. I mean, earnings aren't great. I'll put that caveat out there, but the way markets trade, it's between expectations and reality. And man, expectations have just been so dire the last 12 months. And you look at a lot of these economists and strategists look dead wrong now. They've been a little too negative, and what you're seeing is you're seeing the data come in much better than expected. And if you look at profits, they're actually better than what was anticipated. Hence, the market's had a phenomenal run since like last fall.
Now, we did lower the bar quite a bit, and we're leaping over a lower bar, essentially. But recessionary predictions, we've heard very little of them, few and far between, whereas you go back a quarter, it was all we were hearing. And in fact, we started out with all the big bank CEOs predicting a mild recession. We haven't heard much of that from CEOs who are pointing to the consumer. What do you see?
Yeah, it's remarkable, right? We had that jobs number, which was insane on Friday. Like, that is not a recessionary jobs report. And what blows my mind is that to your point, every strategist, every CEO, jobs report. And what blows my mind is that to your point, every strategist, every CEO is the most anticipated recession of all time. Of course, we were positive the whole way through. We really didn't think that was going to be the case. And now you're seeing everyone shift their tune all of a sudden saying soft landing, like all of a sudden out of the blue. And I think it just speaks to the fact that, look, you've got a strong consumer. And the reason they're strong is we still have some pandemic stimulus left, something like $1 trillion. But more importantly, wages are going up and the job market's strong. That's going to keep people spending this year, and that's what drives the U.S. economy. It's not that complicated.
Ryan, how much does it matter whether or not we do fall into a recession, just given the fact that so much of that fear you would think has already been priced in at this point?
That's a great point, because I always say anticipation is mitigation. Everyone was thinking about recession, everybody's talking about it. So what were those CEOs doing? They're going back in their businesses and they're looking for where they could cut. Where those CEOs doing? They're going back in their businesses and they're looking for where they could cut, where they could actually, rewrite the ship even before any sort of like recession happens. And that's why the numbers are already coming in better, because the hurdle's been lowered. They're already proving their balance sheet ahead of time. That's already being anticipated. So then hence, like, it's already priced into the market. I would argue that was priced in last year. That's why you're getting all this good news now.
True. So you say tech is in the midst of a dead cat bounce. My favorite actual phrase when it comes to the stock market, other than maybe catch a falling knife. Those are my two favorite. Why so? Describe what you're seeing in big tech.
Two good ones, Dave. But I think bottom line is, look, tech has come down a lot. You're seeing a big bounce this year in the Nasdaq. It's up like 16%, but it's still down over 20% from the highs. And I think what you're seeing is very similar to what we saw in the tech bubble burst. You had a huge sell from the Nasdaq. You had all those big tech companies get hammered, and they'd have these big bounces, and then they would go down again. And look, if you look at the big five this past quarter, they had 1% revenue growth. Valuations are still high, so I think that is going to be problematic for them moving forward. They may just do nothing for the next couple of years, just because you kind of have to get those valuations down.
Couple years.
Microsoft did nothing for 13 years after the tech bubble burst. People forget that. So tech can be dead for a long time. Don't be seduced into these rallies.
Isn't AI and ChatGPT the one X factor there?
How are they going to make money with that? No one's talking about that. I know it's cool technology, but I don't hear anything about like real profits with that stuff. That's way down the line. Yeah, I wouldn't be focused on it.
So you don't like tech right now. What do you like in this environment?
I think I'm enamored with almost everything else. Energy still looks good this year. Financials look great. Lending's going up. So they're making a lot of money on those net interest margins. You're still getting nothing at the bank as they're out lending money at a much higher rate. So banks should do really well this year. And I think the global markets, the biggest catalyst this year, forget the Fed. Everyone loves to talk about the Fed. And I talk about this in my Pain Points About podcast, the best in the country, is China. The reopening of China is huge. Europe benefits from that disproportionately to the U.S., but even the U.S. is going to benefit from that. Everyone benefits from China reopening. They have about like $2 trillion worth of stimulus sitting in their accounts to spend. That has a huge impact on the global economy. You have to have a global portfolio.
You're not suggesting the Fed don't matter, are you? Because I'm a Fed lover here. And Jen Schomburger just gave us the latest Fed speak. And the market is falling back in line with what the Fed's been saying now for this entire tightening cycle. What's your prediction? Do you think we're headed for two more 25s and a hold until 24?
Yeah, I think worst case scenario 225s, but the bond market's telling you everything, right? The bond market peaked months ago at 4.2% on the 10-year Treasury. It's down to 3.6%. Bond market, the bond guys are smarter than the Fed officials. So I think bottom line is inflation's coming down. The Fed here eventually is going to pivot. Powell's already said like 11 times in a speech the other day, disinflation. He's acknowledging it now. It's over. You know, those Fed officials can stop talking.
Right.
That's it. They can stop talking.
Done.
Mr.
Please.
Powell, you heard it from Ryan Payne. Pain Points of Wealth podcast. Good to see you, my friend. Thank you.
Thanks, Dave.
All right, Uber's CEO says his company just reported its strongest quarter ever, but can lift its results. We'll break down what investors need to know ahead of their earnings report tomorrow.
Uber shares moving to the upside, up just about 5.5% today after reporting key wins. Uber CEO Dara Khosrowshahi saying, quote, "We have clearly separated from our competitors and driver preference." Uber rival Lyft is scheduled to report its fourth quarter earnings tomorrow. So where does that leave Lyft? Yahoo Finance tech reporter Ali Garfinkel is here with more on this. And Ali, let's start with Uber because the share popping 5.5% today. Certainly very pleased by not only what we got from the results, but also what we heard from the earnings call.
Yeah, absolutely, Shauna. It's important to remember here, some of these numbers are really key. Uber reported a 49% year-over-year revenue growth. And yes, that's a pandemic story. The narrative is that the company is benefiting from these post-pandemic trends. And Lyft, in theory, should be set up to benefit from some of those trends too. So I kind of wanted to pull out three things that are really important to think about as we're looking at this. The first is drivers. The driver shortage is more or less over, is what we're hearing. And though it affected Uber, it certainly affected Lyft. In fact, I want to pull out a quote from 2021 where co-founder Logan Green said in an earnings call that bringing more drivers onto the system takes time and it's like turning the Titanic. So if they need to attract those drivers so that their back is simply not enough. The other thing I think we should be watching is Q4 active riders. So that's expected to come in at 20.3 million, but Uber's app is seen as more diversified and stickier. So the real question for Lyft is going to be, are they attracting users? Are those users staying? And the third thing to remember that's kind of going to come down the line, but I think we will start to maybe hear some murmurs of it, is Lyft is really US-centric. Uber is more international, and there are concerns about the regulatory environment for these rideshare companies down the line. So that's kind of the situation that Lyft is walking into here, and it's a tricky one.
No doubt. It's just so interesting to see Uber up 5% and see Lyft now down 6+% on the day. What's the bull case for Lyft?
You know, candidly, Dave, I'm not entirely sure. However, what I can tell you is that there are growth numbers. Like I was looking at a Raymond James report, for instance, that said Lyft's daily active users are up about 4% year over year this quarter, building on 8% year over year last quarter. So there is growth. It is slow. Again, logically, it seems like they should be benefiting from some of these post-pandemic trends, but we'll see. It's important to point out here, Dave, in analyst world for Lyft, 19 buys, 23 holds, 2 sells. So there are bulls out there.
Yeah, they're completely untethered, really, in their reaction. That's what's interesting. When you watch the cruise lines rise and fall together on the same piece of news, rarely happens recently with Uber and Lyft, which is a fascinating dynamic. Ellie Garfinkel, thank you. All right, coming up, Under Armour shares falling after warning that there will be more discounts ahead. We'll tell you some of the biggest headwinds management is seeing on the other side of the break.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Capri, Under Armour, and TripAdvisor. Let's kick it off with Capri Holding. It's a top trending ticker here on Yahoo Finance today. Shares selling off just about 26%. Now, this is the retailer that owns Michael Kors, Jimmy Choo, Versace, just to name a few in the portfolio. Falling today after missing on estimates and also cutting its annual profit forecast. The latest sign that consumers are curbing their spending because of those higher prices that we've been talking about. It's certainly a reversal from what we saw last year. CEO John Idle noting that the performance in the third quarter was, quote, more challenging than anticipated and is making moves to, quote, better align operating expenses with the change in revenue. Now, global wholesale pressures were a challenge during the holiday quarter. Simeon Siegel of BMO Capital Markets, who has an outperform rating still on the stock following these results, said that he still sees Capri as, quote, an inexpensive cash generator, but warned that results will likely weigh on the stock in the near term, given the recent run-up that we have seen in shares of Capri Holding ahead of these results. And Josh, this is just the latest retailer here to warn that consumers are shifting their spending. They're pulling back just a little bit, certainly seeing some of those concerns reflected in the drop today.
And I want to focus in on Michael Kors for a second, too, because we talk a lot about luxury brands, right, and how the luxury consumer stayed so strong. The luxury consumer stayed so strong. And Michael Kors is a little bit of a different luxury brand, right? It's not a Louis Vuitton or one of the really high-end brands. But that revenue fell 7% year over year, Dave. And I think that's sort of interesting to see Michael Kors maybe a entry-level luxury brand, right? We're kind of starting to get into the luxury section there, sort of on the lower end. It's not Louis Vuitton. It's not Gucci.
I don't even think it's in the ballpark.
Right. So that consumer, though, that's probably younger, doesn't have quite as much money, is starting to pull back. So we're starting to see even more of a pullback there.
Yeah, look, we're just seeing certain sectors notice what you mentioned there, the consumer pulling back. We just had a segment on Uber, and Dara Khosrowshahi said he's literally staring for it. He's looking through it. He's combing through reports and said he sees zero pullback in consumer spending. So, yeah, we see a little bit of it there, but in most sectors so far with earnings, we're in fact not seeing.
Retail, though, certainly has been hit hard. On Uber's position, though, they've got the monopoly. They've got that market
maybe
share.
That's
not a lot of
services, though, as well. We go from goods to services.
Retail, there's so many options, and that's something I know we've talked about off air, too. You can go a million different places and buy a different shirt, right? So right now, it's who has a sale. And if you don't have a sale, you're not winning. That's my play today, guys, with Under Armour, who's had plenty of sales, but unfortunately, I think they might have had a couple too many sales. So let's take a look at Under Armour. You can see shares down about 8%, and that's really one of their worst days in a while here. And the company reported third quarter earnings that beat the street. But what happened is really on the call. So the stock was up before the call, up almost 7% this morning. Then the call happens, and the CFO said earlier on the call that basically what happened here is that promotions are going to extend longer than they anticipated. So promotions are going to go further than they initially thought. They're going to go almost to the end of the year. And they highlighted that the consumer, they think, is weaker than people thought retail-wide. So across the sector. Again, we were just talking about Capri. We saw it in Under Armour. I think we're seeing it play out, but it's interesting to start hearing that commentary now, too.
I think it's an Under Armour problem, and it's Stephanie Leinartz's problem now. Their new CEO comes aboard after 25 years at Marriott, and she's got a lot of problems to solve there at Under Armour. And Kevin Plank, the founder, saying on the call, we look forward to her prioritizing top and bottom line growth for Under Armour. Stephanie Leinartz has her hands full. They're going to open a pop-up Tuesday in Manhattan, something called Slip Speed, a new shoe that actually converts into a slide from a training shoe. Big bet, one she didn't make.
Yeah, I'd be interested to try those on, Dave. I don't know how
I'm
those
not
are
sold
going to
on
play
that.
out.
I'm not sold. I just think Under Armour, if you take a step back, they've lost their cool factor. Not nearly as many people are wearing them as opposed to what, 10, 15 years ago. They need to be a little bit more innovative with their products, I think, to really kind of boost their business and better
Nike
compete
took
with
it,
Nike.
man.
What happened to the Under Armour brand that used to be the turtleneck, right?
Yeah.
That was called an Under Armour.
Yeah.
To stay warm. And now you have a Nike one, and you don't even wear the Under Armour one with that little
I still
turtleneck,
wear
right?
mine
You
when I
guys
run
still have
outside.
them?
Forgot
Yeah.
about that.
Yeah.
They keep
Mock
it nice and
neck,
warm.
actually, I believe.
Right.
Not the full turtle.
You won't see any of those on Sunday at the Super Bowl day.
No, you will not, my friend. My play is TripAdvisor. The stock surging on a double upgrade from Bank of America to buy from underperform. The bank anticipates upside of almost 60% as consumers book more travel. Analyst Nat Schindler writing, quote, core Trip remains a cash cow that, while not a significant grower over time, can both fund and drive customers to high growth Viator. Now, you may not have heard of that. That is one of the largest online tour and activity booking agencies that TripAdvisor acquired back in 2014. Viator has been arguably Trip's best performing brand recently. Shares up well over 5% earlier today, have come back down to earth, just over 3% up on the day. They will report earnings on Tuesday the 14th. Still seeing that beneficiary of the conversion from that I mentioned earlier, goods to experiences, people still traveling.
Yeah, certainly. And this call here on TripAdvisor is just the latest upgrade that we've seen overall in the travel sector. We've talked a lot about Citi's recent call on the cruise lines, people spending more as they plan out some of these trips. TripAdvisor, obviously a huge beneficiary as people do plan their upcoming travel. You gotta question, though, if we are headed for such a slowdown, what some are still predicting that we could see, even though there is this demand to travel right now, you might be second guessing some of those trips, at least in the short term.
But if you are traveling, which right now it seems like people are, right?
They're looking for a deal.
You have to use TripAdvisor or something like it, right? So I think that's where it is for now. You're right. In 6 months, we might be having a different conversation.
Exactly. All right, well, coming up next, big tech is among some of the top holdings of an ETF that's aligned with the mission of the NAACP. We will tell you all about it next.
Impact Shares NAACP Minority Empowerment ETF is on a mission to provide exposure to companies with strong racial and ethnic diversity policies in place, and investors are buying in. The fund's seeing gains of more than 8% since the start of the year. Joining us now is Marvin Owens, Impact Shares Chief Engagement Officer, and this week's ETF report brought to you by Invesco QQQ. Nice to see you, sir. Tell us about this fund and what separates it from others.
Great to be here. Thanks for having me. It's an interesting fund in the sense that we are unique in the market in that Impact Shares is a 501c3 nonprofit. And so we work with leading environmental and social advocacy groups to basically take their missions and translate them into investable products. The first fund that we built and created in partnership with the NAACP is NACP. And what we did was we utilized the NAACP's 100+ year history of advocating for corporate policies around racial equity and diversity and inclusion. And we used that strategy as a way of applying it to publicly traded companies on the Russell 1000. What you have in this index are companies that have been scored and ranked using criterion provided by the NAACP. So investors who are looking for companies that are committed to good policies around racial justice or racial equity can look at NAACP as an opportunity to kind of see who those companies are. We're also set up in a way that we would provide the net advisory fees back to the NAACP to support their ongoing corporate engagement work. So it's a really unique product in the market. There's nothing much like it any other place.
Marvin, I'm looking at your top holdings here. Apple, Microsoft, Amazon, NVIDIA, Tesla, all dominating those top holdings. I know you were mentioning that criteria that you guys go through in order to identify these holdings, but what is that common thread, other than the fact that all those companies are tech companies, that you're seeing as to why they are the top holdings in this fund?
Well, it's interesting because those tech companies are also a pretty significant part of the U.S. market, quite frankly. But I also know that those companies are of the size that they have really interesting and really committed internal policies around racial equity. And so I think the real issue here is not that the companies are in our index are perfect. It really means that these companies have scored well relative to their counterparts. The companies in the fund are not companies that have gotten it right or gotten it perfect, but they are companies that have scored well. The key here is the engagement aspect of the fund. We are a 501c3 that's actively engaged with the companies, in addition to the NAACP being actively engaged with many of these companies to advocate for the kind of policies that represent racial equity.
There has been loads of research, frankly, showing big tech's lack of diversity, its racial wealth gap, its racial worker gap. Is that a false narrative?
No, it's not. But it also means that these companies have scored well relative to their counterparts. Again, these companies aren't perfect, and there's lots of work to be done. And the goal here is not to just have an index fund with a bunch of companies in it, but there has to be active engagement in order to improve those scores. Good example, when we launched 3 years ago, a company like American Airlines didn't make it into the index because their score was just not good enough. They did not score well. And so over the years, there's been active engagement with a company like American Airlines, led by the NAACP. And after that engagement took place over the couple of years, we did our rebalance last year, and American Airlines made it in. The engagement is really what makes the difference. These companies aren't perfect by any means, but they are striving toward and committed to the kinds of policies that represent racial equity.
And Marvin, you also have another ETF, a mortgage-backed securities ETF, owns OWNS. What can you tell us about that and why you launched this fund?
Yeah, as an advocate for more than 20 years working in the economic empowerment space, the question of what do we do to close the home ownership gap and what do we do to close the racial wealth gap was always a key issue. And so home ownership is a key strategy to closing the racial wealth gap. And OWNS is set up as a mortgage-backed securities ETF, agency-backed securities. We're talking about Fannie, Freddie, agency-backed securities. We're buying mortgages that are in persistent poverty communities, so that these are communities that of high minority presence, as well as communities that have historically been the recipients of redlining. And so we are actively engaged in driving investment back into those communities. So we're focusing in on communities of color and building this ETF around that strategy. What we've been able to do is really been able to focus in on the fact that there is nothing like this in the market as well. There's nothing like the mortgage-backed securities ETF that's really focused on Black home ownership. What we've been able to watch because of our partnership with a company like Redfin, we've been able to see a $27,000 increase in value in the homes that we're buying these mortgages, which means that these Black families are seeing an increase in their net worth. We're very interested in making sure that we're not just creating another ETF product that is similar to what's already in the market, but we really want to see active, focused impact on communities of color. And we're beginning to see that with the OWNS product.
All right. Affordable Housing ETF, ticker OWNS, OWNS. Marvin Owens, thanks so much.
Thank you.
The rise of artificial intelligence. Now you can see shares of Google's parent company Alphabet sliding today. We're looking at losses of nearly 8%. The losses coming after it promoted its new AI chatbot. Clearly the street is not impressed, but tech giants are butting heads over the future of AI. Here's everything you need to know about that battle.
Silicon Valley's tech giants are poised for a fight over AI superiority. Here's what you need to know.
The emergence of ChatGPT has led to an arms race in the tech sector as Microsoft and Google scramble to integrate generative artificial intelligence into their search platforms. Microsoft revealing it will begin using OpenAI's ChatGPT in some of its products, including its Bing search engine, as the company looks to capitalize on ChatGPT's popularity to take market share away from Google.
It is definitely a new day for search. The opportunity to bring and infuse AI and new chat-like experiences with the tools that people use the most on the web today, which is the search engine and the browser, is an opportunity to do something completely new.
Just this week, Google releasing its own AI chatbot to compete with the Microsoft-backed ChatGPT. Google CEO Sundar Pichai introducing the newest entry in the AI revolution. It's called Bard, and like ChatGPT, Bard is a generative AI with a conversational interface, meaning it can create conversations on its own and provide simple explanations for complex problems. Pichai says Bard will be open to the public in the coming weeks. And of course, China's tech sector can't let American companies have all the fun. Hong Kong-based Baidu also getting in on the action, announcing plans to release its AI chatbot called Ernie in the coming months. All of these companies are still in very early stages of AI development and are looking at integrating this technology across their platforms and into our lives, from search to cloud to gaming and beyond.
Ditching plans to consolidate its content onto one app, Warner Brothers Discovery is shifting strategies. According to a report in the Wall Street Journal, the media giant will be keeping Discovery Plus as a standalone streaming service. For more, we're joined by Yahoo Finance's Ali Canal. So why this decision?
So apparently they don't want to risk losing a chunk of those Discovery Plus subscribers, which right now are about 20 million. Now they're still going to have this new combo service that's expected to launch sometime in the spring with HBO Max content and most of Discovery Plus content, but they're also going to keep that standalone Discovery Plus service. Wells Fargo estimated that the overlap between HBO Max and Discovery Plus is roughly 4 million in the US. And with this new platform, it's widely expected to be called Max. We don't have pricing on it at the moment, but if you take a look at the pricing of both HBO Max and Discovery Plus, it's probably going to be a little more. HBO Max costs $16 a month or $10 with ads. Discovery Plus is $7 a month, $5 with ads. So we'll just have to wait and see. But I don't know, this company to me, it seems like things are messy right now. You know, it's just like they don't know what to name it. They don't want to, you know, roll out they're just back and forth all the time.
And the stock falling about 5% today on this, perhaps on this news.
Yeah.
Or
And
the disorganization.
I reached out to Warner Brothers. They did not even get back to me. So it just seems like it's all over the place. Right now.
Yes, it certainly is all over the place. A bit messy, that is safe to say. All right, Ali, as we're talking about these streaming wars, Netflix cracking down, expanding its crackdown that we've been talking about on passwords. 4 more countries added to the list?
4 more countries. That's going to include Canada, New Zealand, Portugal, and Spain as of today. And this comes after that meltdown we saw last week where Netflix unintentionally updated their help page that listed some of the password sharing crackdown. And I just got to say, I've received so many emails from concerned Netflix subscribers. Like, I'm talking lengthy. I'm like, I am now the Netflix therapist because they just don't know what the answer is. And there's a lot of questions out there too. If you own multiple homes, if you're a snowbird, how do you set your primary location? So it seems like Netflix is going to have to answer to a lot of this. We do have potentially a little hint at what it would cost to add members that are outside of your household. For example, if you want to add an extra member to your account, you can add up to 2 people that you don't live with for an extra $7.99 Canadian dollar per month in Canada. So you have to think it might be roughly the same in the US, but I'm just thinking about, I'm one of 3 kids. If there is only 2 spots,
do you still use your parents'
Of course I do.
Oh my goodness.
Are you kidding me?
Actually, I think I'm the only sibling in my family. I'm one of 5. I think I'm the only one that doesn't use my parents.
Is that right? I'll tell you, investors may like it in the long run. This is going to be really ugly
And
in the
analysts
short
like
term.
it too. I mean, you talk to all of them. They say Netflix had to do this, but I mean, we'll see.
Certainly getting some backlash online on social media, that is for sure. I know it's not even here, so just wait until it actually comes to the US. All right, Ali Canal, thanks so much. Well, coming up, we are counting down to the closing bell on Wall Street. Losses across the board. We've got Disney reporting results after the bell. We'll be right back.
All right, just a few minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action. What are we seeing, my friend?
Well, let's talk about some earnings. First up, Fortinet. That begins our journey. Up in nearly 3 years here. That goes back to the beginning of the pandemic. That's after the cybersecurity company delivered better than expected guidance for the year. In an area of cost consciousness now, Fortinet may be bucking the trend of penny pinching. That's what analysts are saying. Now, take Piper Sandler. They're rating the stock neutral, but they are upping the price target to $64 from $57, saying Fortinet's resilience was on full display, noting the strength of its billings and its forecast. But KeyBank downgraded the stock with no price target on concerns the company's growth is slowly becoming the growth is slowing more than expected. Also checking out Manchester United with just a few seconds to go here. We got some news that a Qatari sport investment company is leading an international investor group to buy either Man U or another Premier League club. Report also noting that this cannot be a full takeover as long as Qatar is involved. Also owns another club, but the scent of M&A is in the air, and the stock is up the most since rumors were flying back in November. That would be right here. And here's the closing bell.
All right, that's the closing bell. It's time for a drink. It looks like with Anheuser-Busch ringing.
No beers
the
up
bell.
there, though.
No beers ahead of the Super Bowl Sunday, huge weekend.
Oh, wait, there they are.
There they are. Everyone's partying. Everyone's having a
bottles.
good time. Thank goodness.
You know, they're giving up their exclusivity in the Super Bowl ads, so we're going to see all sorts of not just other beer ads. We're going to see Diageo advertising liquor as well with Crown Royal. Different game this year.
Certainly a different game, right? Supermanian is going to be joining us for the next hour here on set. We want to take a look at some of the top movers of the day as we round up today's trading day. Let's start with Chipotle. It was a huge mover after the bell yesterday. Shares today falling just about 5%. Investors digesting concerns over higher prices and their impact on customers. Here's what CFO Jack Hartung told Yahoo Finance about pricing earlier today.
We don't have any plans to dial the menu price increases back, but we don't have any plans to raise prices either. You know, frankly, Brian, the last year and a half, inflation was just kind of in a, runaway kind of mode, and we were just trying to keep up with it. What we are doing, though, is we've been watching very closely our customer reaction, and most of our customers are coming the same amount of times or even more, since we've taken some of these price increases. We are seeing some softness in our lower income customers, but we're also seeing that they're spending less in restaurants generally. So it's not just a Chipotle thing.
All right, it's not just a Chipotle thing, but when you take a look at these numbers, same-store sales did miss, growing 5.6% compared to the estimate on the street of 7%. So clearly, it looks like there might be some pushback from their consumers about those higher prices.
Yeah, some growth there, but transactions smaller. They're ordering fewer things, lesser priced items there. Cutting back on deliveries, actually they noted that, which is actually good for them because that's a positive impact on margins. They want higher foot traffic. Maybe you might see some people coming in more than actually ordering. Also noting that Brian Nichols, CEO, noting that there's higher price, 100,000 plus household income people coming in more so than the 70,000 plus below income earners. So you're seeing a bit more of a switch in terms of the mix of people coming into Chipotle.
Yeah, you're seeing those higher income trade down where you're seeing the 75K just can't afford. And that's probably why they are not continuing to raise those prices. Nothing more telling than this stat when you look at visits to Chipotle down 10% in the quarter, where McDonald's is up 29% in the quarter. That's just a number of visits in Q4, which we talk a lot about what's happening with the macro economy, Sean. I think that's the best look at it. They are trading down as we file in and talk about another company that has reported. It's Yum Brands as well. And who crushed it with Yum Brands? Taco Bell. Taco Bell did so well. Why? Because it is cheap. And even they said they're seeing $100,000 and up consumers trade down, where he's seeing those $75,000 and under earners really go for their combinations, their combos.
Yeah.
So that's largely speaking a great look at how these prices are impacting.
A very good look. Their same-store sales there at Taco Bell up 11%, smashing the street's expectations. Breakfast was a huge hit.
Breakfast did really well.
It did.
Taco Bell, 45 million Mexican pizzas sold too.
Wow, there we go. Now you're talking our language.
In only 4 months, yeah. So really kind of killing it there with the Taco Bell. So really want to quick pivot to Google. One of the company's top Google Lab executives, Clay Baver, leaving the company according to LinkedIn post. He's teamed with former Salesforce CEO Brett Taylor to start an AI company. Speaking of AIs, Alphabet shares closing lower, down nearly, 8% there. Tech giant hosted a presentation to show off some of the AI features. Our senior tech reporter, Ali Garfinkel, here to discuss more about that. What's going on here? Why is Google Bard kind of just getting a really lackluster response?
Yeah, this was a question I had too, Pras, and there were a couple of things that became immediately clear as I started talking to experts. The first was that there were fears about Bard's accuracy pretty much right out of the gate. Basically what happened, I'm not an astrophysicist, but Bard was asked about new discoveries from the James Webb Space Telescope, and the sentence was presented sort of oddly, and what you ended up with was something that was actually technically accurate, according to Financial Times reporting, but presenting a broader problem about interpreting how these chatbots, right? So on one hand, you have that, and then on the other, the showcase wasn't necessarily what people were expecting. I spoke to a couple of SEO experts about this who follow Google like it's their job because it is. And what they were saying is that the showcase really reiterated and expanded on features that already existed. One example of this is the Search Your Screen feature for Google Lens, and that was talked about by the company as being in beta back in 2021. So a lot of stuff that's being expanded, but not a lot that's new. And the last thing that's maybe worth noting is that the presentation itself was kind of on Google-like in certain ways. One analyst I saw was using the word underwhelming, and an SEO expert I was talking to, actually just outside the studio, the story is developing so fast that I was talking to him and got this quote from him literally 5 minutes ago. What he said that I thought was really profound was, we wanted to see something that was a game changer, and instead what we ended up with was them talking about subtleties.
You know, I'm just kind of sort of confused as to why Google, Alphabet, all this money, all this firepower they can bring to AI is getting outgunned by OpenAI, a very small startup in Silicon Valley. What happened there? I can't understand how they got so far behind in AI.
Well, what's interesting is Google, part of the subtext of this presentation today was Google saying, we developed the technology. I don't know if you remember the fuss over Lambda over the summer where an engineer came out saying it was sentient. Every AI expert I've talked to said there is no way it is sentient. And I think that, you know, there's part of what's happened is that, frankly, they haven't leveraged that technology as well as they might have expected, particularly not with user interface, which is what they've become known for. The other thing, too, is I think shots are very clearly being fired right now from Microsoft. Satya Nadella, I know in an article today was saying, from now on, the gross margin of search is going to drop forever. What does that mean? What he's suggesting is that Google won't be able to keep up with search as these searches get more expensive and complicated and as these margins compress.
In retrospect, it was very telling. About 3 weeks ago, the New York Times reported that Larry Page and Sergey Brin had returned to Google, clearly panicking that they were falling behind in the AI race. It didn't seem like much then. It sure looks like a lot now. They knew how big a problem this could be for Google. Ali, thank you. Great stuff. Okay, closing things out here with Tesla shares closing higher as CEO Elon Musk teases out his master plan part 3 in a tweet last night, writing, quote, Master Plan 3, the path to a fully sustainable energy future for Earth, will be presented on March 1st, ending it with the future is bright. No subtle promises, no subtle guarantees when it comes to Mr. Musk, Pras. What is this master plan?
You know, you kind of got to tease out what he's alluding to, right? And he's talking about not just, you know, our sustainable future in terms of energy creation, but also what are you going to be driving there, right? That's their company. That's the whole thing. And so, you know, obviously a couple of takeaways that I'm thinking, a couple of things I'm looking forward to on March 1st is, you know, are we going to hear more about that Gen 3 cheap platform, that robo-taxi? Musk says he needs to see 20 million cars made by 2030 a year to kind of see that vision. Probably going to result in 12 new gigafactories. So we're going to hear more about when are they going to make those factories, right? Where are they going to be? And also, what about resources? Are we going to see more deals for lithium and cobalt? Things like that. You know, they have a deal now for a lithium refinery in Texas. Are we going to hear more about that? How are they going to bring those resources in? Finally, you know, that clean energy. Where is it coming from? batteries, mega packs. Are they going to build more
mega packs?
Yep.
That's what I want to hear all about. I don't know if we will. I don't know if investors are going to be disappointed.
All right, guys, I want to jump in here with Disney results. Their earnings being released here just a moment ago. You're looking at shares up just a fraction here in extended trading. In terms of the top and bottom lines, we're seeing a beat from Disney. Revenue coming in $23.51 billion. Estimate was for $23.37 billion, so a slight beat there. Adjusted EPS of 99 cents. The estimate was for 74 cents. We're taking a look at its DTC business. Revenue during the quarter increasing 13% to $5.3 billion, but operating losses were coming in at $1.1 billion. Also, Disney Plus subscribers, that number missing the street's estimates, 161.8 million. The estimate on the street was for 164 million, so a miss there. Total Hulu subscribers, 48 million. That's also a miss, a million light. The estimate was for 49 million here. But again, the street, or again, shares moving slightly to the upside here after hours on the headline beats on both the top and bottom lines. Also, their parks division, revenue there, $8.74 billion.
On expectations of, do you know what those were?
Looking here, no, we're just looking at the $8.74 billion there on parks. But still, you got to take into account the fact that some people might be pulling back some of their spending. The $8.74 billion number, talked about how crowded those parks are. It looks like pretty strong results there for the company in that division.
Yeah, it's just become the expectation, hasn't it, that the parks are going to continue to perform. I was at Disney just a couple of months ago. I can tell you every single hotel on the property was sold out for the entire time I was there. They are strong. You have
certainly, and it is a beat on the expectation there for parks. The $8.74 billion estimate was for $8.08 billion, so beat there.
Considerable
in their parks division as well. So again, the stock slightly higher here, Pros, in after-hours trading.
Yeah, I don't see a slight miss there. I think you mentioned, Sean, and Disney Plus subscribers down like about 2 million miss off there. So, we're hearing that Iger's going to focus more on profitability as opposed to expanding growth with those Plus streaming numbers. So I want to maybe hear a bit more color on that. Not obviously always a good thing when you don't hit those numbers, but if you're able to kind of charge more for that service, and grow not at the highest rate, but also just kind of increase the margin there. It's a good thing too. Obviously, that parks number, we're all really curious about that and how that's trending. And I imagine holiday numbers were so strong. How are we going to see that trickle into 2023 is pretty big.
Yeah, and also in this report, the company saying that it recorded charges of $69 million related to exiting our business in Russia. CEO Bob Iger in the earnings release, the statement there, we believe the work we are doing to reshape our company around creativity while reducing expenses will lead to sustained growth and profitability for our streaming business, better position us to weather future disruption and global economic challenges and deliver value for our shareholders there. But again, beat on both the top and bottom lines for Disney, although Disney Plus subscribers, a slight miss there by just about 2 million.
Will be interesting to hear reducing expenses. What exactly does Mr. Iger mean? Will there be layoffs ahead for Disney? Shauna, get out of here. Be sure to stick around tonight, 5:30 Eastern Time. Shauna Smith, Brad Smith will be recapping Disney's earning call with breaking down everything you need to know. You're stuck with Pros and I the rest of the way. We're going to take a deeper dive into Disney's first quarter results right after this break. Don't go away. All right, earnings alert now. Robinhood shares trading up almost 60% after posting earnings. Yahoo Finance's Inez Ferre here to break down the numbers. Inez, what jumps out to you?
Yeah, that's right. Well, adjusted loss per share for Robinhood's fourth quarter came in at 11 cents. That was in line with expectations. Revenue came in below Wall Street expectations. It came in at $380 million. The street was expecting $389 million. I want to point out crypto revenue for the fourth quarter came in below expectations. That came in at $39 million. The estimate was for $45.8 million. No surprise there since we're in a crypto winter. Also, monthly active users, that came in slightly below expectations at 11.4 million. The street was expecting 12.2 million. But look, analysts were expecting user growth to stay flat. They were expecting it to steady from the previous quarters. Also, taking a look at the earnings release, Robinhood announcing that its co-founders are canceling nearly $500 million of their share-based compensation, saying that Vlad Tenev and Baiju Bhatt announced that they have canceled their 2021 pre-IPO market-based restriction stock unit awards, which total 35.5 million of currently unvested shares. So you are seeing shares now up in after hours. And by the way, year to date, this stock is up 28%, guys.
Inez, thank you so much for that. Turning now to Disney, trading higher right now in the after hours. First quarter earnings beat on the top and bottom line. Disney Plus subscribers are coming in just shy of the street estimates, but still pretty close. Let's bring in Tigris Financial Partners CIO Ivan Feinseth. Ivan, what are you looking at here? What are your main takeaways?
Well, I think overall really good. I think the concern and the bright spot are the parks, because that is really insight in consumer spending trends. I mean, you could say that Disney Plus could do well or not do well. People are just sitting home, not going out, but consumers are traveling. Travel demand is across the board strong for cruises, for flights, for theme parks. And that is a good indication of the strength of the consumer, or at least the consumer's willingness to spend and the measure of their confidence that they will spend on travel. Because when things become, start to slow down and people have economic concerns, the first thing they cut back is on travel. So I think that is a key bright spot. And Disney's flywheel, I say all the time that content is king and Disney is the king of content. And their revenue flywheel is driven by the creation of the content, because content drives movie theater releases, it drives streaming content, it drives licensing revenue, and it drives visits to the parks. So the content continues to drive everything, and that slight miss in the subscribers, I don't think is a concern at all. Because they got The Mandalorian coming out, and I think long-awaited season 3 of The Mandalorian, and that's really what put Disney Plus on the map to start with. That was one of their first shows, and it was phenomenal out of the gate, and really drove the launch of Disney Plus.
Yeah, that parks number is remarkable. 21% increase year over year. It just continues to produce quarter after quarter. What do you make of the DTC number you're seeing, Ivan?
I think it's great. I mean, I think that they will continue. They have a lot of content in the pipeline, and I think that will grow the sustain and that drive the growth of the DTC subscriber membership and revenue. And I think it will be sustainable growth for a long time. And they will continue to be able to produce, because season 3 of The Mandalorian is much cheaper to produce than season 1. They had to build out all the sets. They said that, season 1 cost $20 million an episode. Well, in reality, it cost $160 million to create, produce, and get everything ready. Then season 2 was cheaper, season 3 will be cheaper, and so on and so on.
Yeah, Ivan, so looking at this Disney sort of broadcast and entertainment business here, sort of flat-ish for the quarter. Do you think that we're going to see anything hear anything from Bob Iger about the future of ESPN, the future of Hulu? Like, are they going to unlock some sort of revenue streams or even divest some of these?
Yes, things? I think that is what everybody's waiting to hear. Remember that it was very fortuitous that they launched Disney Plus when he did. He introduced it in April of 2019. It was launched in November of 2019, and we went into pandemic lockdown shortly thereafter, and streaming saved them, and it was really incredible. And So I think the next thing is the only real way they could leverage ESPN is through gaming, and Disney does not want to get involved in gaming. I mean betting. Yeah. So they need to create some kind of partnership with that. And I also think, well, that they would be better off owning Hulu 100%. And maybe starting to license some of the content to other channels, or even if they don't own a Hulu and buy the rest of Hulu, this concept of licensing their content to other channels is interesting, because we're already seeing that, even though, for example, all of the Yellowstone and the 2 prequels of Yellowstone are all from Paramount. The prequels are on Paramount Plus streaming, but the Yellowstone show on streaming on that is actually on Peacock.
Love that show, my favorite. Bob Iger says we believe the work we're doing to reshape the company around creativity while reducing expenses will lead to sustained growth. Where do you think that reduction comes from? Do you think we'll hear anything about layoffs? They do have a labor difficulty right now, let's call it. 96% of the union turned down the latest contract proposal. Where do they cut costs?
Well, I think I can't tell you one big spot, and probably they can't either. I think they'll do it in a lot of smaller places, because the parks are going at full capacity. You need people in the parks to, one of the great things about Disney's park success is the experience, and the experience is driven by the innovation and the staffing. I mean, their parks are always fully and nicely staffed. They need the creativity and content pipeline, as I said, because that drives the whole flywheel. So I don't really know how you cut back there. So it will be interesting. So I just think that rather than cut, I think they're going to have to try to get more out of what they have, and especially more content production from what they have. I think that's going to be the key area.
Yeah, I mean, speaking of more of what they have and trying to leverage that, reports that Disney might license some of their content to third parties. Do you think that's a strong possibility? And it's easy money, but does that hurt the Disney brand and possible exclusives to Disney Plus?
No, Disney's brand is so powerful. And I think it would do the reverse. Sometimes if you're watching some Disney content on another channel outlet, say, hey, I want to join Disney Plus. So I think it would have the effect of potentially increasing incremental revenue from other licensing, and I think it will drive membership growth, because if you like the content, you may go to the source and go to Disney Plus as well. I mean, they already started to talk about showing season 1 of The Mandalorian on ABC. So they're already talking about, now that they do own ABC, but so they are looking for ways to put previous content out in other channels.
Investors like it. Shares up about 2% after hours. They don't love it. They're waiting for that call like Ivan is. Ivan Feinseth, good to see you, man. Thank you. Coming up, lawmakers were riled up during last night's State of the Union address. Stay tuned to see some of the spiciest moments.
Check it out. After the Disney earnings call ends, that's when we go live. Brad Smith here with Shauna Smith. No relation, but of course, Yahoo Finance family. We're going to be breaking down what the tone, what the vibe of the call is. Of course, anything on streaming, all things Hulu, all things Disney Plus, and all things ESPN Plus.
I'm going to be looking for any cost-cutting measures, talks about layoffs, what exactly that looks like. And also, this is Iger's big return. They've called in the GOAT. Lots of anticipation.
Quick, favorite Disney movie?
Oh gosh, that's a toss-up. I'm going to go with Moana or The Lion King.
Done deal. Oh, I'm going Aladdin. Yo, you can check us out after the Disney call ends. Yahoo Finance begins.
We'll see you then.
Last night's State of the Union put our divided government on display for all to see, with a lively crowd that openly responded to President Biden as he gave his speech. Joining us now with his reaction to the address is Mark Morial, National Urban League CEO and President. Nice to see you, sir. One of the more fiery moments of the night found controversial Congressman, to say the least, Marjorie Taylor Greene, calling the president a liar when he addressed a conservative proposal to cut Social Security and Medicaid. Listen.
Instead of making the wealthy pay their fair share, some Republicans want Medicare and Social Security to sunset. I'm not saying it's a majority. Let me give you, anybody who doubts it, contact my office. I'll give you a copy. I'll give you a copy of the proposal. That means Congress doesn't vote. Well, I'm glad.
You see MTG there dropping liar right there, Mark. What did you make of that moment? And did it end up being a masterstroke for President Biden, who then got everyone in that room to commit to, all right, we're taking that off the table?
It was a brilliant power move by President Biden. And Marjorie Taylor Greene is a performance artist. She craves media attention. So we're giving her what she wants, and that is attention. But what she did was she forced the hand of her own caucus to thereby say in public, we're not going to cut Medicare or Social Security. Let's see if they stick to their word on this. Because as you know, Medicaid and Social Security, important parts of this safety net for the American people, is broadly popular and should not be touched for political reasons. And I do believe that President Biden was energetic. He was fiery. I kind of like the feisty Joe Biden, who gave a impassioned defense of the work he's done. And I think talked about things like police reform. He talked about, if you will, reforming a whole host of corporate practices that sort of nickel and dime the American people, and a range of issues related to his blueprint for the American economy. So it was a strong performance. And once again, Joe Biden, underestimated by many pundits, beat expectations. And that's what's important with this year's State of the Union.
Hey, Mark, sticking with the economy, you also saw the president getting some jeers. He went off a little off script talking about the oil and gas industry. Let's take a listen to this.
When I talk to a couple of them, they say, we're afraid you're going to shut down all the oil wells and all the oil refineries anyway, so why should we invest in them? I said, we're going to need oil for at least another decade, and that's going to exceed and beyond that. We're going to need it.
Sort of a mixed message there from the president on the energy industry. What's your take on that, talking about how we want to transition, but we need a decade more power?
Anyone who knows this issue understands that there's a road to a renewable future. And it is a gradual road, because not only does the technology, the capacity, and the capability have to be developed, there are investments needed in order to do this. So oil and gas is going to be used for the foreseeable future in the transportation sector primarily, natural gas in the utility sector, as we transition to a more renewable future. So, maybe you could quarrel or quibble with details and specifics about what the president said, but the president was being candid. And he was also answering alarmists who seemed to suggest that if you're for renewables, you mean you want to shut down oil and gas production. And this sort of polar discussion is really inconsistent with what we must do as a country to move to a different type of energy future.
Interesting when we're talking about the economy here, and he had some strong talking points. I agree with you on the energy and the feistiness, and he has those jobs numbers at his back. But we saw a Gallup poll today showing 50% mark of the American public says they're worse off today. He'll get a little short-term bounce here. Every president does. But can he move that needle and convince Americans that they are, in fact, doing better?
That's the work ahead of the president. But I think the American people, there's a COVID overhang. There is a sense that the soul of the nation has been negatively impacted by racism and racial division in this country and partisan divisions and the attacks on American democracy. So I think that what you see in these numbers is a channeling of how people feel on an overall basis. And let's be honest, it is expensive to live in America today. Housing is up significantly. The cost of food is up significantly. So I think we should give the president due credit for the incredible rebound from the COVID recession that he inherited from Donald Trump and the creation of millions and millions of new jobs at a pace faster than any presidents, including Reagan and Clinton, while understanding that there is a lot more work left to be done. If we pass the child tax credit, if we raise the minimum wage, if we did a few things, we could create relief for working, middle class, and poor Americans, and we could put a dent into poverty. The tragedy of America's economy today is the many, many people that work hard every day and still cannot make ends meet. So the president should be judged, is the economy better off today than it was when he took office on January 20th, 2021? And I think that answer is clear, but there is a tremendous amount of work to be done.
Mark, you mentioned the child tax credit. You know, Biden talking about how that he wants to see that expanded. Can we actually see that happen with this Congress? And then how important is that to be done?
This is so important that the president and those that favor the child tax credit build the public will. The GOP and the filibuster have been obstacles to this. We had the child tax credit. We could not make it permanent because in the negotiations, this was something, remember, that Senator Manchin objected to, but was never clear as to why he objected to this very important provision, which would benefit many, many people in his state and across the nation. The minimum wage has not been increased on a national basis since 2007, I believe, and therefore 25 states, half the states roughly, have increased their minimum wages on their own, but a national minimum wage is better economic policy than a patchwork system. This will test Joe Biden's persuasiveness, but it will also test whether the GOP is truly interested in bipartisan engagement versus obstructionism.
Big year for Washington for 2023, that's for sure. Mark Morial, National Urban League President and CEO, thank you so much. Coming up, tax season just got more complicated. Find out why the IRS is telling millions of Americans to wait before filing their taxes. Next.
Everyone's favorite agency, the IRS, advising millions of Americans to wait to file their taxes. Here's why. 19 states issued some form of stimulus or rebate checks to the residents last year, including California and Florida. But the IRS is still trying to figure out if those payments are subject to federal tax. Here with more is Yahoo Finance's personal finance editor, Jana Herron. Jana, it's a little more than 2 weeks till tax season. What is going on here?
I know. I mean, in the early signs too, where before this happened, that this was going to be maybe a boring tax season, maybe a little normal, but then boom, the IRS is like, nope, we got this little problem. And the problem is the IRS did know about these stimulus checks that these states sent out, so they should have ruled much earlier whether or not they're taxable on your federal tax returns. So it's really leaving a lot of people in a lurch, especially since about 17 million Americans have already filed their returns. So now we have a little bit of chaos.
Indeed we do. And the stimulus checks the federal government sent out during the pandemic weren't taxable. Do the tax experts you talked to have any idea how the IRS will rule here?
Yeah, sure. So it is correct that those pandemic stimulus checks were not taxable by the federal government. And typically, the tax code says that if the federal government sends out a stimulus check, the federal government does not tax it. And if a state sends out a state stimulus check, that state doesn't tax it on their returns. But this is a little bit more complicated because you have not only the federal government involved, but you have these states involved. And so what gets even more complicated is that the purpose of these stimulus checks vary depending on the state. Some sent them out because they had a surplus in tax revenue, and some sent it out because people were having a hard time with inflation. So it's really going to be a state-by-state determination that the IRS has to make, so it might not even be one size fits all.
So if you already paid your taxes, which I can't believe people actually did that, if you actually did that, what do you do now if you've gotten some stimulus money?
So if you're one of those people who have filed your taxes already, and you're in one of those 19 states, they might have to correct your return eventually, but we don't know that yet because the IRS has not told us. And hopefully when the IRS has some kind of guidance that they put out, it also includes some instructions to people who have already filed. Now, people who haven't filed and they're in those 19 states, just wait. Wait for the guidance to come out. You just don't want to complicate taxes anymore because it's already a frustrating experience.
Wait, I can do that with the best of them. Any other takeaways about tax season?
I think it's almost normal now that tax season is not normal. So like for the past several years, like last year, we had all those tax breaks from the American Rescue Act. In 2021, the tax filing date started in February because the IRS was sending out a second round of stimulus checks. And in 2020, what was happening then? Oh, right, there was that pandemic that shut down the IRS for a little while, and the tax deadline got moved back to July. And even in 2019, there was a federal government shutdown. I don't know if you guys remember that. And then also there were all those tax cuts from the Trump administration. So who knows what's going to happen next year?
We'll keep our fingers crossed.
Right.
All right, Jana Herron, thank you. Great stuff. Appreciate that. All right, let's take a look at now what's trending after hours. Jared Blickery is here. What's moving, my man?
Let's take a look at Disney. We rehashed the numbers. Let's take a look at the stock. It is up about 5% in after hours trading. I'm going to put a chart on real quick. This is a one-year chart. Tomorrow morning, if we were to stay at these prices, I believe it was 115 and change, we would be looking at the highest price since September. And just taking a quick look at the 5-year chart, bouncing off those lows we saw in the pandemic, maybe off to a little bit of a start here. Now, we got to move on to a firm. We're also tracking the buy now, pay later company firm after its quarterly revenue missed estimates, with its loss widening to $360 million. The big headline regards its workforce. A firm is cutting it by 19%. This also happens to be how much its stock was down at the lows in after hours trading. The company is seeing annual cost savings of $77 to $83 million from the downsizing. It's also delaying some of its projects. Full year revenue guidance is now $1.475 billion to $1.55 billion. This is below the estimate of $1.64 billion. So all in all, a firm, this is that big Amazon excitement spike that we saw last year and still hanging out in the lower end of its range. Got to move on to Mattel, also in our sights after missing on profits for the fourth quarter. By segment, the toy maker missed expectations in dolls, as well as a set that includes action figures, building sets, and games. Now, Mattel's products for infants, toddlers, and preschoolers also came in substantially light, but it's a full-year forecast that's helping send the stock down to the lowest price in a month in after-hours trading. Mattel is seeing adjusted EPS for the year of $1.10 to $1.20. Street estimate substantially higher at $1.65. Adjusted gross margin also came in light at 47%, below the 48% expected. Now here's a 5-year chart of Mattel. You can see doing a little bit better than some of our other guys here, but still about in the middle of its, how would we call that, a 2-year trading range, and definitely in the upper part of its 5-year trading range. Guys.
Jared, thank you so much for those technicals, my man. Coming up, Robinhood shares on the move higher after reporting Q4 earnings. Our next guest tells us why 2023 will be a transformative year for the fintech platform. Back after this.
All right, an earnings frenzy continues. Shares of Robinhood trading up more than 3% after reporting Q4 earnings. Let's break down the numbers with Dan Dolev, Mizuho America's senior financial technology analyst. Nice to see you, sir. So what stands out? What do investors like about this report?
Yeah, hey, thanks for having me on the show again. I think if I look at the results right now, the one thing that stands out is the MAUs, the monthly average users. They're still coming down, but the rate of decline is actually getting less bad, which is a huge positive in my view. Obviously, they're also the ARPU, the average revenue per user, is climbing. I think it went from 63 to 66. And sort of the highlight or the creme de la creme of the reporting is EBITDA. They're moving from 47 million of adjusted EBITDA positive to 82 million. So that's a huge step up in EBITDA. So kind of like, if you kick the tires on this one, you're getting like solid revenue, higher interest income, not as much decline in ARPU or an improvement in the decline in MAUs, better ARPU and like much better EBITDA. So like the cost controls are working. So I think across the board, it looks really strong.
Hey, Dan, we teased this coming up with you're saying this is a transformative year for Robinhood. Why do you think that's the case?
Yeah, I think they've sort of matured, right? I think that when people started looking at Robinhood last, in 2021, it felt like this sort of meme stock, crypto kamikaze kind of, stock, right? And I think really management has stepped up. I met with Vlad recently, and I think that they really understood, hey, we need to be adults about this. We need to turn this into a viable, long-term, winning exchange that, caters to younger people. And I think they've accomplished that, right? And I think the next step is going to be even more interesting, which is they're offering retirement products, and they're actually targeting international markets. So I think sort of the next 2 years of Robinhood are going to be more exciting than the last 2 years.
What is the hangover from the FTX mess and where crypto is today?
It's the hangover is more on the sentiment. I mean, I'm not as big of an expert on like the government has the funds in custody, the stake, Sam's stake in it. Like, let's leave that aside. From a fundamental perspective, I think right now the hangover is more just about general crypto sentiment. If I look across the board in all the companies that we cover, right, in terms of the exposure to crypto, Robinhood is actually surprisingly not as, it has this like cachet of being this, meme sort of crypto center, but it's really not, right? They make the vast majority of the revenues on equities, options and interest income. Crypto is just a small portion. So I don't think it's as impacted. If you're looking to short a crypto exchange, Robinhood is not your name. It's, Coinbase, et cetera, et cetera.
Hey, Dan, just switching gears to Affirm stock shares and move lower here after announcing earnings. They're announcing some layoffs as well. What's your kind of main takeaways here with Affirm?
Yeah, I know. Now I'm turning from like laughing to I want to cry. So the mood, my mood just changed dramatically now. So I'm going to put on a sad face. But look, this was very disappointing. I think the most disappointing thing to me personally on Affirm, and I'm a big bull in Affirm, and I do believe in the long-term story, is that you knew that provision. So let me just explain this. Sort of the provision, which is a headwind to revenue, is going up, right? You knew that it went from 1.5 to 1.9%. That was a known thing. We did the deep dive on it, and that drags down your take rate, right? And because it takes down your take rate, you knew this was coming. What we didn't see was coming is that they actually missed their volumes. They missed the low end of the volume, and that's kind of like an ouch, right? Like, you don't want to see that. Like, I can live with take rate pressure because of an accounting procedure or measurement. It's harder to digest a GMV miss, volume miss. I think that's kind of what stands out on Affirm. By the way, I want to say one good thing. I know the stock is tanking, and I do expect the stock to come down tomorrow. But I want to say one good thing. Delinquencies, which has been like a huge issue, they're actually coming down. Like, if you look at the 30-day delinquencies, they're coming down literally across the board. So they can underwrite really, really well. Maybe that's also related to the volume miss because they're closing the funnel. They're not giving as many people loans. This could be the explanation. So they're balancing volume versus delinquencies very well, but it doesn't look good at the bottom line, and that's why the stock's trading down.
And these aren't just layoffs. These are nearly 20%. This is a massive headcount cut. Is this a buy now, pay later industry problem and / Apple getting into that sector, or is it more of an Affirm problem?
No, it's an industry problem. Actually, that's a great point you're making. So we published a note this morning on PayPal. Actually, we looked at the 20 biggest merchant kind of partners to PayPal, and we looked at checkout trends. And sort of the byproduct, the exhaust of this was we actually also looked at some buy now, pay later. Affirm, Afterpay, Klarna. And what you're seeing is that January and December, you're seeing a consistent slowdown in traffic to those websites. It's almost like you could have predicted the GMV miss here. I think it's a macro / e-com issue more than it is an Affirm specific issue. Affirm is best in class, as George Bush used to say, make no mistake. It's best in class, but it's suffering headwind from a bad macro and bad, I guess, sentiment around lending.
Man, when you are best in class and you are down 17%, that is not a class you want to be in. Dan Dolev, thank you, my friend. Appreciate it. Coming up, we've got some details from the Disney earnings call you need to hear about. Look at that stock continuing to increase, up more than 8.5%. Stick around. All right, we're getting some headlines from the Disney investor call. Cost cutting is the theme, and you can see investors reacting to it with shares up more than 8%. Disney is looking to find $5.5 billion in cost savings and will be cutting 7,000 jobs to help do so. CEO Bob Iger also announcing the company is going to restructure into 3 units. And here's the key: Disney Entertainment, ESPN, and Disney Parks Experiences and Products. Praz, what's your reaction?
A lot to parse there, right, Dave? So you hear about those cuts, $3 billion coming in from content alone, but they're not touching sports, right? They're not touching sports. They're leaving that alone. Street loving 7,000 job layoffs. It's hard to say that, but it's true. They do. It is going to be a big cost driver for the company. And then also talking about ESPN, now its own separate unit, right? So what does that mean for the company? Does it make it easier to maybe spin off? Is it easier to account for? Is it easier to kind of separate a sort of still growing or still sort of very valuable property for them? So I think this sort of Iger putting a stamp on things right now, and this is what he's doing.
Yeah, 7,000 cuts. That's about 3% roughly of their 220,000 employee worldwide headcount. So not a significant number to the likes of some of those we've seen in the tech sector in terms of a percentage. So theoretically, without hearing from Bob yet, presumably these are high priced. Probably some executives are going to roll here, not the people that are dressing up as characters, because they're going to have to spend a lot on this labor agreement. 96% of the employees turned down their recent proposal, so they're going to have to really spend up on those employees. I don't think ESPN's going anywhere. I really do not. Hulu is the big question. Will they buy out the remainder of it? I'm going to go yes. What else do you think might happen today?
That's a big point. Rich Greenfield talking about how he might address that big Hulu question mark. What's happening? What's the future of that? Do they even need it when they have Disney Plus, right? Absolutely right about the parks business, the how we renegotiate sort of labor contracts there. It's a booming business. They want to get that addressed. They want to lock that down, get those costs under control, and potentially, kind of have some forward see-through there where they can actually keep it kind of constant. ESPN. This is the big debate, right? Where is that going to go? And I think you make a big point. It's a valuable property. Maybe Disney wants to hang on to that, and then kind of connect with ABC networks, right? So I think that's all part of the whole genesis. This whole part of the kind of all the parts coming together for Disney, and we'll see what Bob Iger says later today.
Good to have parks when they're up 20+% year over year. That'll do it for us on Yahoo Finance Live. Be sure to stick around tonight, 5:30 Eastern Time. Shauna and Brad Smith, no relation, needless to say, will be recapping Disney's earnings call, breaking down everything you need to know. We will see you tomorrow.